Hello and welcome to Wescott's latest economic and market outlook. Today we're going to talk about financial and tax planning during market volatility. My name is Mark McCarron, Chief Investment Officer, and I'm very pleased to be joined today by Steph James, Senior Advisor here at Wescott and special guest. So thanks very much for joining us, Steph.
Thanks, Mark, for having me. It's great to be here, and one of our favorite topics, market volatility. If you can guess, our clients are asking a lot of questions, with the tragic events that are going on in Ukraine and Russia, the Federal Reserve's decision to start raising rates. All of these are impacting that market volatility and have risen a number of client questions that we've received lately. Maybe you can start by looking at our outlook and what's changed since our first quarter outlook.
Yeah, thanks very much, Steph. I think, as you rightly point out, the events in Ukraine surprised markets, and the Federal Reserve actually has continued to sort of put their focus on raising rates this year. Both of those are negatives and headwinds to the market. We expected a rotation out of assets that were negatively impacted or likely to be negatively impacted by rising rates and inflation. That started last year, and it's likely to continue this year. So no major change in terms of expectation, but the speed at which these occurred really did, I think, surprise markets. And the first quarter, as a result, was a pretty weak quarter. Depends on what you look and where you look. The weakness was stronger or more significant in the growth sector, and much stronger on the value side. It had a lot to do with the fact that the energy sector, up 36.9%, was one of the best performing sectors in the market. And that is not uncommon during a period of geopolitical risk like we saw in February. But I think it's important to note that the market volatility has been narrowly focused or specifically impacting parts of the market, but not everywhere. We'll talk about the bond market in a moment, but the equity market was down. If you look at the S&P 500, about 5% or so in the first quarter, but segments of the market were down much less than that. And portfolio strategies that are diversified across all these different styles, like those at Wescott, benefit from the tilt that we had toward these sectors of the market and the underweight that we had to these sectors of the market. We talked a lot about the impact on growth stocks and why they're falling, but in general, they tend to be more sensitive to rising interest rates. And while the energy sector was a very strong performing sector for the quarter, it's not the largest of sectors. In fact, it's a pretty small component of the S&P 500. So while it was up a lot, it didn't really make much of a difference in the overall scheme of things. So I think those are the key themes. Bond markets, though, suffered significantly during the first quarter. And let's talk a little bit about that. So why is that? We expected interest rates to be higher or rise this year. The Fed has been pretty clear in terms of their plans to raise interest rates. And what we wanted to do in this graph is show the relationship between market expectations and what the Fed moves are. So the orange line here, the orange graph, is the market's expectation of what the Fed funds rate will be in the future. And it tends to lead the Fed. So the blue line is the effective funds rate. So you can see it's been 0. And the last time it was up around 2.5% was back in 2018, 2019. It was brought back to 0 following the pandemic, and was pretty much 0 all the way up until the end of last year. Actually, the end of last year, but actually the market began to anticipate the increase in the Fed funds rate at the end of last year, but it wasn't until March, which is where we saw the first increase in rates by the Fed. But the market's already priced in at least 7 hikes, and that's a pretty significant move. And that has a negative impact on the bond market. And while it's painful during this transition, the fact is that bond market is currently offering a higher yield today than it has in many years, which again is a good thing for our client portfolios that are balanced between stocks and bonds. So during periods of volatility, what do we try to do? And we try to think about where the opportunities are, where positioning should be, but we warn against market timing. very, very dangerous, because what we're showing on this graph is the implications of missing some of the best days in the market. So if we look at the return of the S&P 500 for the last 30 years, from 1990 to 2020, the return annualized has been about 10.2%. It's a pretty big return, very strong return. But if you were to miss the best 5 single days of that entire 30-year period, your return would have dropped to 8.6. And if you missed the best 25 days, for example, over the last 30 years, your return would have dropped to 4.8. So it just highlights the dangers of trying to predict or market time, which is something that Wescott does not do in client portfolios. Rather, we're diversified, balanced, and patient. So I would say patience is really what drives long-term success in the market, and it's the best way to keep and maintain a discipline through periods of market volatility. But that's within the portfolio, and what we think about when we build portfolios for the long run. There are other strategies that can be implemented that can add value also during periods of volatility. So I might just turn this back over to you, Steph, to walk us through some of those strategies that you look to implement during periods of volatility.
Great, thank you, Mark. Thanks for the reminder too as to why it's so important to stay patient and think strategically. How can you make your financial plan better? What is the future opportunity that volatility is providing? So we'll talk about 4 tips today. The first being tax loss harvesting. So, when markets go down, it is a great opportunity to see some tax value add. When the markets go down, you look in your taxable accounts for funds that have gone down in value, but that you do still believe in being invested for the long term. There's a wash sale rule that is important to keep in mind. You cannot buy that same or very similar investment 30 days before or after that stock is sold for the loss. Otherwise, it could void the loss. It's also important to keep in mind that this applies across accounts. So you can't sell in one account and buy in another. Having a replacement in mind for a like investment so that when you do sell for the tax loss, you have that other investment ready to put the funds in. You won't miss out on those best days that you had talked about in your prior slide. Also, keep in mind the less obvious areas of the market, like bonds. You may find some losses in bonds that are worth taking. Another tip for today is to look to rebalance your accounts. That old saying of sell when the market's high and buy when it's low. You want to look to pair those winners, pull back from the funds that have done really well in your accounts, and look for those funds that are trading at a discount that you have strong conviction in for that long term. And you can rebalance your portfolio, positioning it for what's going to come outside of that market volatility. So for that market rebound, you could be better positioned. The 4th tip is really a little bit more about peace of mind and how you keep it during market volatility. It's really important that you resist selling equities when the market is doing what it's doing. By looking at your cash needs and thinking about what things you might need from the portfolio for the next 3 to 5 years, and making sure that you've got those funds in low risk investments, that could be in cash and bonds, for example, that will help you prepare your mindset for this volatility and be better to weather it rather than selling into that in a panicked way. The 4th tip is to think about what are the future savings opportunities that you can maximize now. Are you planning on making contributions to your Roth accounts, your 529 plans, or your other health savings accounts? What are the investment opportunities that are there for market volatility? If you can fast forward some of those contributions and you have cash available on the sidelines, you'll be buying in at a discount. And again, the compounding over the long term is really incredible. So they're really the 4 quick tips that we have today to keep in mind on how to enhance your financial plan during market volatility. Be sure to check in with your accountant and your financial advisor. And then I'll bring it back to Mark for closing us out today.
Yeah, thank you very much, Steph. I think those ideas and those tips are very, very helpful. We appreciate you taking us through those. We thank all of you for joining us today. We thank you for your continued trust. As always, if you have any questions, don't hesitate to reach out to your advisor or to me directly. Thank you.